Look, I need to show you something that's happening right now in the silver market that most people have absolutely no idea about. And when I say right now, I mean this week. This isn't some theoretical discussion about what might happen someday. This is about what's unfolding in real time. And if you're sitting on the sidelines waiting for more information, you're going to miss the boat entirely. Let me start with a question that should make you uncomfortable. What happens when the most popular silver coin in the world becomes impossible to buy at any reasonable price? Not next year, not next month, right now. Because that's exactly what's happening with American Silver Eagles, and the implications go far beyond just one coin. Here's what I'm seeing in the market this week. The premium on Silver Eagles, that's the amount you pay above the spot price of silver, has spiked to levels we haven't seen since the absolute chaos of 2020 and 2021. We're talking premiums of $8 to $12 per ounce over spot. Think about that for a second. Silver is trading around $30 an ounce, and you're paying $40 to $42 to get your hands on an Eagle. That's a 40% premium. When was the last time you saw a 40% markup on anything and thought, yeah, this seems totally normal and sustainable? But here's where it gets interesting. This isn't happening because people suddenly decided they like Eagles more than they did last month. This is happening because the United States Mint cannot keep up with demand. And I don't mean they're a little behind, I mean they're rationing coins to dealers. Authorized purchasers, the big distributors who buy directly from the mint, are getting allocation limits. They're being told, you can have this many coins this week and that's it. Now, you might be thinking, okay, so there's high demand for one particular coin, so what? Just buy a different silver coin. And that's exactly what millions of people are trying to do right now, which is creating a cascade effect across the entire physical silver market that's absolutely fascinating to watch unfold. Let me walk you through what's actually happening on the ground. I talk to dealers every single day. These are people who've been in the precious metals business for 20, 30, 40 years. They've seen multiple bull markets, multiple crashes, multiple everything. And they're telling me they've never seen anything quite like this. It's not that silver is unavailable. You can still buy silver. But the spread between what you can sell it for and what you have to pay to buy it has blown out to levels that indicate serious stress in the physical market. Canadian maples, which are usually $2 to $3 over spot, are now running $5 to $7 over. Austrian Philharmonics, same story. Even generic rounds from private mints are commanding premiums of $4 to $5 when they should be at $2. And here's the kicker. These premiums are rising while the spot price of silver is relatively stable. That tells you something very specific is happening in the physical market that has nothing to do with the paper price on the COMEX. So let's talk about why this matters beyond just the inconvenience of paying more for coins. Because what we're witnessing right now is a stress test of the entire silver market structure, and it's revealing cracks that have been there for years but nobody wanted to acknowledge. The silver market operates on two completely different levels. There's the paper market, the COMEX futures, the London bullion market, the ETFs, where billions of dollars of silver trades every single day. And then there's the physical market, where actual metal changes hands. For decades, these two markets have been connected by a thin thread of trust. The assumption has always been that if you own paper silver, you can convert it to physical silver whenever you want at roughly the spot price plus a small premium. That assumption is being tested right now, and it's failing. Here's what's happening behind the scenes. The big banks and institutions that make markets in silver have been running a fractional reserve system for years. They sell claims on silver, futures contracts, unallocated accounts, ETF shares that far exceed the amount of physical silver they actually have in their vaults. This works fine as long as most people are content to own paper claims and never ask for delivery. It's the same model banks use with deposits. They don't keep all your money in the vault. They lend most of it out and count on the fact that everyone won't show up asking for their cash at the same time. But something has shifted in the past few months. More and more people are asking for physical delivery, not just retail investors buying Eagles and Maples. I'm talking about large institutional buyers, family offices, high net worth individuals who are saying, I don't want a claim on silver. I want the actual metal in my possession. And the system isn't designed to handle that level of physical demand. Let me give you a specific example of how this plays out. In January of this year, the COMEX had about 300 million ounces of silver in registered vaults. That's silver that's available for delivery against futures contracts. Sounds like a lot, right? Except the open interest in silver futures represents claims on over 900 million ounces. That's a 3-to-1 ratio of paper claims to physical metal. And that's just the COMEX. That doesn't include all the unallocated silver accounts in London, all the ETF shares, all the other paper claims floating around the system. Now, most of the time, this doesn't matter. Futures contracts get rolled forward or cash settled. People trade in and out of ETFs without ever thinking about the underlying metal. The system hums along just fine. But every once in a while, something happens that makes people nervous. Maybe it's inflation. Maybe it's a banking crisis. Maybe it's geopolitical tension. And when people get nervous, they start asking for their metal. That's what's happening right now. And the Silver Eagle premium spike is the canary in the coal mine. Here's why eagles specifically are the pressure point. The U.S. Mint is required by law to produce enough silver eagles to meet public demand. That's literally in the legislation that created the program back in 1986. But there's a problem. The Mint doesn't mine silver. They don't refine silver. They buy silver planchets, blank coins, from a handful of suppliers who source their silver from the open market. And right now, those suppliers are having trouble getting enough silver in the right form to make planchets fast enough to keep up with demand. You might ask, why can't they just buy more silver? They can. They are. But here's the bottleneck. Turning raw silver into coin-quality planchets takes time. You need specific refining capacity, specific minting capacity, specific quality control processes. You can't just flip a switch and double production overnight. The Mint has been running at maximum capacity for months, and they still can't keep up. So what happens? Premiums spike. And when premiums spike on the most popular coin in the market, it creates a psychological shift. People start to think, if I can't get eagles at a reasonable price, maybe I should buy whatever silver I can get right now before premiums spike on everything else too. Which creates more demand for maples, philharmonics, generic rounds, bars, everything. Which pushes those premiums up. Which makes more people nervous. Which creates more demand. You see where this is going. This is a classic squeeze dynamic. And the fascinating thing about squeezes is that they're self-reinforcing. The higher premiums go, the more people want to buy before they go even higher. The more people buy, the tighter supply gets. The tighter supply gets, the higher premiums go. It's a feedback loop that can run a lot further than anyone expects. Now, let me connect this to something bigger that's happening in the precious metals space right now, because this isn't just about silver coins. This is about a fundamental shift in how people think about wealth preservation and what they trust. Quick aside here, if you're sitting on $100,000 or more in retirement accounts and you've been thinking about how to protect that wealth from what's coming, I put together a free guide on how gold IRAs actually work. It's in the description below. Covers the mechanics of getting physical gold into your retirement account without triggering tax penalties, what the costs really are, how to avoid the common mistakes people make. Worth checking out if that's relevant to your situation. No pressure. Just there if you want it. Anyway, back to what's driving this entire move. Because the Silver Eagle premium spike isn't happening in a vacuum. It's happening at the exact same time that we're seeing record demand for physical gold, record central bank buying, record outflows from the dollar, and record concern about the stability of the financial system. These things are all connected. Let me paint you a picture of what the smart money is doing right now. And when I say smart money, I'm not talking about retail investors or even most financial advisors. I'm talking about the people who manage billions of dollars, who have access to information and analysis that most of us will never see, who think in terms of decades rather than quarters. These people are buying physical precious metals at a pace we haven't seen since the 2008 financial crisis. Not ETFs, not mining stocks, not futures contracts. Physical metal that they're taking delivery of and storing in private vaults. Why? Because they understand something that most people haven't figured out yet. The entire global financial system is built on a foundation of debt and currency creation that cannot be sustained indefinitely. And when that foundation starts to crack, not if, when, the things that have real, tangible value are going to be worth a lot more than pieces of paper that represent claims on value. Here's a specific example that should make you think. In 2022, central banks around the world bought over 1,000 tons of gold. That was a record. In 2023, they bought even more, over 1,030 tons. And in 2024, they're on pace to exceed that again. These are the same central banks that spent the previous decade selling gold and telling everyone it was a barbarous relic with no place in a modern financial system. Now they're buying it as fast as they can get their hands on it. Why the change? Because they see what's coming. They see the debt levels in the United States, Europe, Japan, China. They see the political dysfunction that makes it impossible to address those debt levels through spending cuts or tax increases. They see the only way out is to inflate the debt away by printing more money. And they know that when that happens, Gold and silver are going to be the assets that preserve purchasing power. But here's the thing about central banks buying gold. They're not buying it on the COMEX. They're not buying ETF shares. They're buying physical bars and taking delivery. They're draining physical supply out of the market and locking it away in vaults where it's not coming back out. And every ounce they buy is one less ounce available for everyone else. The same dynamic is starting to play out in silver, just on a smaller scale because the silver market is so much smaller than gold. When you have large institutional buyers deciding they want physical silver, not paper claims, it doesn't take much demand to overwhelm the available supply. And that's exactly what we're seeing with the Silver Eagle premium spike. Let me give you some numbers to put this in perspective. The entire global silver market is about 1 billion ounces a year. That includes mining production, recycling, everything. Of that billion ounces, about half goes to industrial uses. Solar panels, electronics, medical applications, things that consume the silver and take it out of circulation permanently. Another chunk goes to jewelry and silverware. What's left for investment demand is maybe 200 to 300 million ounces a year. Now compare that to gold. The gold market is about 4,000 tons a year, which is roughly 130 million ounces. But gold doesn't get consumed. Almost all the gold ever mined still exists in some form. It gets recycled, melted down, turned into different products, but it's still there. Silver is different. Once it goes into a solar panel or a circuit board, it's gone. The quantities are too small to make recycling economical. So, what happens when investment demand for silver increases? There's no big stockpile to draw from like there is with gold. You can't just melt down old jewelry or coins to meet demand because most of the silver that's been mined in the last 50 years has been consumed. You're dependent on current mining production and whatever recycling you can scrape together. And if investment demand exceeds that available supply, prices have to rise to ration the available metal. That's the setup we're in right now. And the Silver Eagle premium spike is telling you that we're already at the point where available supply can't meet demand at current prices. The question is, how much higher do prices need to go to balance the market? Here's where it gets really interesting. Because silver has this unique characteristic where it's both an industrial metal and a monetary metal. It's used in real products that people need, but it's also seen as a store of value and a hedge against currency debasement. That creates a dynamic where industrial users and investment buyers are competing for the same limited supply. Think about what that means in practical terms. You've got solar panel manufacturers who need silver to make their products. They have contracts to fulfill, production schedules to meet. They can't just decide not to buy silver because the price went up. They have to buy it regardless of price. At the same time, you've got investors who are looking at inflation, looking at currency debasement, looking at the instability in the financial system and deciding they need to own physical silver as insurance. They're also willing to pay higher prices because they're not buying silver to make a profit. They're buying it to preserve wealth. When you have two groups of buyers who are both price inelastic competing for limited supply, prices can move a lot further than anyone expects. And that's before you factor in the speculators who see the squeeze developing and pile in to try to profit from it. Let me tell you a story about what happened the last time we had a real silver squeeze. It was 2011. Silver had been in a bull market for a decade, rising from under $5 an ounce in 2001 to over $48 in April 2011. The move from 30 to 48 happened in just a few months, and it was driven by exactly the dynamic I'm describing. Physical demand, overwhelming available supply, premiums spiking, people panicking and buying whatever they could get their hands on. I remember talking to dealers during that period. They had lines out the door. People were buying anything silver, coins, bars, silverware, jewelry. It didn't matter. The premiums on Silver Eagles went to $10, $12, $15 over spot. Some dealers just stopped selling because they couldn't replace their inventory at any reasonable price. And the whole time this was happening, the experts on TV were saying it was a bubble. It was irrational. It couldn't last. They were right that it couldn't last at that pace. Silver peaked at $48 and then crashed back to $30 within a few weeks. But here's what people forget. It didn't crash because the fundamental demand went away. It crashed because the COMEX raised margin requirements 5 times in 2 weeks, making it prohibitively expensive to hold futures positions. They essentially broke the squeeze by changing the rules of the game. Could they do that again? Absolutely. Will they? Probably, if things get out of hand. But here's the difference between 2011 and now. Back then, the squeeze was driven primarily by speculative demand. People were buying silver futures and ETFs, not physical metal. This time, The demand is for physical. And you can't break a physical squeeze by raising margin requirements on paper contracts. If people want metal and there's no metal available, the price has to rise until demand is rationed. That's why the Silver Eagle premium spike matters so much. It's telling you that we're already in the early stages of a physical squeeze. The question is how far it goes and how long it lasts. Now, let me address something that I know some of you are thinking. If premiums are this high, isn't that a sign that silver is overvalued? Shouldn't I wait for premiums to come back down before buying? That's a logical question, and it's exactly the wrong way to think about what's happening. High premiums aren't a sign that silver is overvalued. They're a sign that physical silver is scarce relative to demand. The spot price, the price you see quoted on financial websites, is the price of paper silver trading on the COMEX and in London. It's the price of a promise to deliver silver at some point in the future. The premium is the price of getting actual metal in your hands right now. When premiums spike, it means the market is telling you that paper promises and physical metal are not the same thing. Think about it this way. If you owned a futures contract that entitled you to take delivery of 1,000 ounces of silver at $30 an ounce, and the premium on physical silver was $10, you could theoretically take delivery and immediately sell the physical metal for $40 an ounce, making a $10,000 profit. Why doesn't everyone do that? Because taking delivery is complicated, expensive, and time-consuming. You need to arrange for shipping, insurance, storage. You need to have the capital to pay for the metal up front. Most people who trade futures have no interest in dealing with physical metal. They just want to speculate on price movements. But some people do take delivery, and when enough people start doing it, the available supply of physical metal shrinks and premiums rise. That's what's happening right now. The people who are willing to jump through the hoops to get physical metal are draining supply out of the system faster than it can be replaced. Here's another way to think about it. The premium is the market's way of telling you what physical silver is really worth right now, not what some computer algorithm says it should be worth based on futures contracts trading in New York and London. If you can't actually buy silver at the spot price, then the spot price is meaningless. The real price is spot plus premium, and right now, the real price of Silver Eagles is $40 to $42 an ounce. So what does this mean for you? What should you actually do with this information? First, understand that we're in a unique moment. The combination of factors driving physical precious metals demand right now, inflation, currency debasement, geopolitical instability, loss of faith in institutions, isn't going away anytime soon. If anything, these trends are accelerating. The debt levels are getting worse, not better. The political dysfunction is getting worse, not better. The trust in the financial system is eroding, not strengthening. Second, recognize that physical precious metals are insurance, not speculation. You don't buy them hoping to flip them for a quick profit. You buy them because you understand that the paper wealth you've accumulated over your lifetime is only as good as the system that backs it. And that system is showing cracks. When you own physical gold and silver, you own something that has been recognized as valuable for thousands of years, across every culture and every economic system. It's the ultimate form of financial insurance. Third, accept that you're going to pay a premium to get that insurance right now. Yes, it would be nice if you could buy Silver Eagles at $2 over spot, like you could a few years ago. But you can't. The market has changed. The question isn't whether you want to pay a $10 premium. The question is whether you want to own physical silver or not. Because if you wait for premiums to come down, you might be waiting a long time. And if this squeeze continues to develop, premiums could go a lot higher before they come down. Let me give you a framework for thinking about this. Imagine you're buying fire insurance for your house. The insurance company tells you the premium is going to be higher this year because there have been a lot of fires in your area and they're having trouble getting reinsurance. Do you say, well, I'll just wait until premiums come down before I buy insurance? Of course not. You pay the higher premium because the risk of not having insurance is too great. That's where we are with physical precious metals right now. The premium is higher because the risk is higher. The system is more fragile. The potential for a crisis is greater. The smart move isn't to wait for a better price. The smart move is to get the insurance in place while you still can. Now, I want to be clear about something. I'm not telling you to go out and put your entire net worth into silver. That would be foolish. What I'm saying is that if you don't have any physical precious metals as part of your overall wealth preservation strategy, now is the time to fix that. And if you do have some, but it's a small percentage of your assets, now might be the time to increase that allocation. How much should you own? That depends on your individual situation, your age, your risk tolerance, your other assets, your goals. But as a general rule, Most financial advisors who take precious metals seriously suggest somewhere between 5 and 20% of your investable assets. Some people go higher, some go lower. The point is to have enough that if the system does crack, you have something of real value that will preserve your purchasing power. And here's the thing about physical precious metals. They're one of the few assets that have no counterparty risk. When you own a stock, you're dependent on the company performing well. When you own a bond, you're dependent on the issuer making payments. When you own real estate, you're dependent on the property market, the tax system, the legal system. When you own physical gold or silver in your possession, you're not dependent on anyone. It's yours. It has value because people have agreed. It has value for thousands of years. That's powerful. Let me bring this back to the immediate situation with Silver Eagles. What's going to happen in the next few weeks and months? I don't have a crystal ball, but I can tell you what the indicators are suggesting. The U.S. Mint is not going to suddenly double or triple their production capacity. The bottlenecks in the supply chain are real, and they're not going away quickly. That means Silver Eagles are going to remain scarce, and premiums are going to remain elevated. How elevated? That depends on demand. If demand continues at the current pace, premiums could go higher. If demand moderates, premiums might stabilize where they are. But I don't see a scenario where premiums come back down to historical norms anytime soon. The spillover effect to other silver products is going to continue. As Eagles become harder to get, people will buy maples, philharmonics, generic rounds, bars, whatever they can find. That's going to push premiums up across the board. We're already seeing it happen. The question is how far it goes. The paper silver market is going to come under increasing pressure. As more people take delivery of physical metal, the available supply in COMEX warehouses is going to shrink. At some point, if this continues, we could see a situation where the paper price and the physical price completely disconnect. We've seen glimpses of this before. In 2020, during the COVID panic, there were times when you literally couldn't buy physical silver at any price while the paper price was trading at $17 an ounce. That disconnect didn't last long, but it was a warning sign of what can happen when physical demand overwhelms supply. The big question is whether this develops into a full-blown squeeze or whether it fizzles out. And that depends on factors that are hard to predict. How the economy performs, what happens with inflation, whether there's a crisis that triggers a flight to safety, how central banks respond, what happens geopolitically. There are a lot of moving pieces. But here's what I keep coming back to. The fundamentals for precious metals have never been stronger. The debt levels have never been higher. The currency debasement has never been more aggressive. The geopolitical tensions have never been more complex. The trust in institutions has never been lower. All of these things point in the same direction, toward higher demand for real assets that can't be printed or debased. Silver, in particular, has this unique setup where it's undervalued relative to gold. It's essential for the green energy transition, and it's starting to be recognized as a monetary metal again after decades of being treated as just an industrial commodity. That's a powerful combination. So here's my take. The Silver Eagle premium spike isn't just a temporary anomaly. It's a signal. It's the market telling you that something fundamental is shifting. The era of cheap, readily available physical precious metals is ending. We're entering a new phase where physical metal is going to command a significant premium over paper claims. And the people who recognize that shift early and position themselves accordingly are going to be glad they did. The choice is yours. You can wait and see what happens. Hope that premiums come down. Hope that the system holds together. Hope that your paper wealth maintains its purchasing power. Or you can take action now. Pay the premium, get the physical metal in your possession, and sleep better at night knowing you have real insurance against whatever comes next.